Stocks closing in on bear market territory. We may be in that today. The S&P is just 1 percentage point shy of being 20% below its April 29th high. For more on the markets, we're joined by Morgan Stanley's U.S. equity strategist, Adam Parker, of course, Dominic and John here as well. And Adam, a lot of the traders yesterday were saying, look, 1100 is a very key level. We broke through that. Are we now headed towards perhaps an S&P at 900?
I don't believe so. We've written that it ain't great, but it ain't 08 was the title of a note we wrote a few weeks ago.
Rhyming, I like that. I didn't know you had that in you.
Yeah, it's unusual for me, but no, I do think that you don't have that many companies that have debt obligations in excess of their current assets, meaning they're not going to go bankrupt. So I think what you alluded to earlier is the fears in Europe are weighing on the U.S. market. I think our main call this year has been that the market multiple is going to contract in the U.S. So, the earnings are one thing, but what you pay for them, that multiple is another. And we continue to be somewhat cautious on the multiple, but I don't see it as bad as 2008.
Well, Adam, the last time you spoke with us, you talked about that multiple because it's ironic. We look at your estimates for profits in the S&P 500. They're right about average, right around the median, $96 for next year. You're looking at right around that same level. What is it that's driving that multiple contraction? Why are people not paying as much for a dollar of earnings today as they have been in the past?
There's several things, and it's a great question. I think number one, it is fear about Europe. Number two, the economy today in the U.S. is propped up by fiscal stimulus and a very accommodative monetary policy, and ultimately you'll have to unwind those things, meaning, you're not real sure if 2013 GDP will be much above 2011, and so it's about sustainability, really. That's why people don't want to pay for it. And I think lastly, by the way, the pain trade might be to the extent that fears in China on a hard landing grow. That would be the third pillar that could cause more multiple contraction.
Adam, it's John Erlichman. Let's talk about how you make money in a market like this. Your team puts together different portfolios of what stocks might outperform. I know you've been playing defense, the defensive names. Utilities are that one group that have outperformed the market over the course of the year. You had names like Entergy, American Electric Power, and Ameren in that portfolio. Are these the kinds of stocks that you guys would be parking in during all the uncertainty?
Well, we're overweight utilities. We're also overweight healthcare. The reason to be overweight defensive sectors is because their estimates tend to be more achievable in volatile times. Think about what happened in the July earnings season. The reward for beating estimates was way smaller than the penalty for missing, right? So if you know that if you miss, you're really going to get punished, that impacts your positioning. It means to me you want to be focused on sectors and stocks that have more defensible characteristics.
And just to follow what he was saying about healthcare, Bristol Myers, United Health, and AmerisourceBergen are three names that they have had in their portfolio of stay safe stocks.
Well, it's not just that. Remember, those names, the utility names, a lot of these healthcare names, defensive names, tend to have dividend yields as well that are above average, so you get paid to wait as well. I mean, Adam, is that also a strategy for you as well, the dividend payers? Is it important to a strategy for investors right now in volatile times?
It is particularly important. We wrote a note a few weeks back about that. What you want to own are stocks that yield between 3 and 6%. That there's some defensible nature to that dividend, meaning they're also buying back stock or they have cash or they're not paying out, the payout ratio is low, so you have confidence that that's a sustainable dividend. We're able to show in risk-averse regimes that high-yielding stocks tend to subsequently outperform. In fact, if you looked at 80 or 90 variables and what helps you predict return, dividend payout ratio and dividend yield have been among the most effective factors in the whole stock market over the last few months, and I think that speaks to where people's heads are.
Adam, what have you gotten rid of, though? I mean, what have you gotten rid of in your portfolio or in your view?
We're underweight industrials. We're underweight consumer discretionary. I'd say right now it's about estimate achievability, in other words, the estimates accelerate, and we think that's probably unlikely to be met. And so we want to really avoid companies that are at risk during earnings season here over the next couple weeks.
Okay. Now, really quickly, I mean, earnings season is kicking off in just about a week or so here. Any expectations? Is it a positive one? Maybe not so much?
I think it'll be less upside than we've seen in the previous couple of earnings seasons, and I think if you look across the industrial sector and a couple other spots, you've seen some misses in the last couple of weeks, and you've seen those stocks be punished.
Right.
So without getting too stock specific, I'd say really focus on industrials and consumer in particular, because if they miss, I think it'll bring the market lower.
Adam, thank you. Adam Parker of Morgan Stanley.